cost segregation loophole that's like the new kid on the block. That is the way that you can get losses on your short-term rental and then offset them on your W-2 income. Normally on real estate, you can't. But today we are breaking down with Ryan, a CPA, that showed me this strategy first in this episode coming up next. Welcome to the Cash Flow Happy Hour podcast. I'm your host, Josh Baldovino, and on this show, you can join us live as we interview investors and share how they are increasing their cash flow. So grab a drink and let's get into it. Ryan, man, welcome back to the show. How you doing today?
I'm back.
You are back. For context for everyone, there is a first episode, and I will link that down below, that we did actually on my Joshua Tree Airbnb. But dude, you have been absolutely crushing it. So for those who don't know who you are yet, Ryan, what's the quick 30-second origin story and how'd you get into real estate?
Yeah, I had a strong accounting and finance background, spent a lot of time analyzing financials, businesses, and just know if something's going to cash flow or not, right? And it wasn't until I combined that with the tax strategy of learning how, basically real estate investors can choose not to pay taxes if they're smart. Once I combined the two, it was game over. So I went to work for a Big Four consulting firm and was realizing that I was helping people who are already rich and wealthy become even more rich and wealthy. And I decided I wanted to help everyday people like you and me become change our family tree. So I've been doing that ever since, full time. 3 different businesses, CPA firm, content creation, public speaking, and then my newest business, which is going to be real estate syndication. So extremely excited about that.
Yeah. Like from last year that we talked to this year, you have been, I don't know, how many conferences have you spoke at now too?
At least 6 or 7.
Dude, good job. Congratulations, man. Well, for the viewers out there who are watching this, the cost segregation, and he'll break it all down, but basically there's not many ways that you as an investor, especially if you have a day job, can offset your taxes with your real estate business. There is a way through short-term rental. And I guess just as a quick teaser, since hearing about it from Ryan, I have now went to the vendors that he's talked with, and one of them, going with Yona over at Madison Spec. And he initially sent us on one property, our Joshua Tree 1, an estimated $60,000 and potentially what we could bonus depreciate on year 1. I had another buddy actually message me yesterday and said, dude, they're expecting anywhere between 130 and 150, like 130 and 150K in write-offs off one property as a short-term rental. Like, I don't like, that's just crazy numbers. Okay, so you have a CPA firm. If you're not following Ryan already on Instagram, learn like a CPA. It's also linked down below. Like, Ryan, what are your clients seeing for, I guess, how about let's even back up? Like, what is this strategy?
Yeah, so I'll give you the high level. I would say if you're a decent W-2 earner in that, I would say 24, 32, 35% tax bracket, those higher tax brackets, on I would say on a $500,000 purchase price, we're seeing an average of $30,000 to $35,000 in tax savings per property. Around those particular price points, to sort of tie a whole bow on the picture, the entire strategy revolves around the idea that there's what are called non-passive and passive activities, and they normally don't mix together. So your non-passive activities are going to be your W-2, your business income, your retirement income, and then passive activities are generally by default all rental real estate. So normally long-term rentals, apartment buildings, syndications, etc. However, there's a special carve out if you look within Section 469 that basically says, hey, if your property is rented out for transient use, so AKA 7 days or less stay, it's not actually a rental activity under those same sort of guidelines. It's actually just like a regular business. It's not a rental. But that's not just enough to do that. You still have to also do what's called material participation. So to basically sum that up is you have to be the one doing most of the day-to-day operations of your property. You can have a cleaner and you can have like a small handyman, but you have to be the one doing most of the work on your property in order to qualify.
Gotcha.
And the strategy allows people who are high earners to, invest in real estate and shelter some of their income and basically build wealth, right? Because if I'm able to save, $30,000, $40,000 per property, I'm able to reinvest that into my business and my real estate, and that's going to grow even further.
So here's why that really excited me. So traditionally, if you have a long-term rental property, which is
Hmm.
kind of what a lot of people start off with, I guess maybe not now, but traditionally, if you have a long-term rental property and you have a W-2, you have active income as your day job, and then you have your passive income with your real estate, and those two can't really mix buckets that well.
Right.
But what you're saying is if you have an Airbnb and you are the manager, you're the few material participate, you now run a hospitality business, which is now active. And so those now can play in the bucket. Um,
Yes. Right. Right.
God, like, and how many people now have you seen started to, use the strategy a bit more?
Well, Josh, it's interesting. So I first spoke in public in person about this in front of, it was about 90, maybe 100 people. And this was in Nashville back in October last year.
Hmm.
And I had actually, during my presentation, I had asked how many people have heard about cost segregation. And in a room full of 100, only four people raised their hand. And I asked how many people have actually done it, and only one hand was remained. And I remember exactly who, because it's actually one of my mentors now. But when I spoke back in Nashville back in this past June at the STR Wealth Conference in front of
Hmm.
850 people, I asked the same question, and more than half of the room had their hand raised.
Dude.
So within a matter of, I would say, 8 months, 8 to 9 months, this whole strategy is absolutely blown up, and a ton of people are using it to change their family tree. It's honestly impressive.
And just so people can like understand what the numbers actually mean. Like, for example, to make numbers square, say if you make $100,000 a year as your active W-2, but you have a short-term rental and you have one property and you do the strategy. If you're getting a $30,000 write-off, that means you're bringing your taxable income from what, 100 to 70 right away, right?
Hmm.
W-
Right.
What are maybe like the top concerns that people have in terms of like, hey, is this legit? Is this real? What do I need to track? Like, what are you kind of advising your clients?
Yeah, I think that the number one concern people always have is how does the depreciation play into their loan ability to
Mm,
get more loans. And so what's happening here is your property is not actually losing money. The cash flow is going to hit your bank account. It's just we get to tell the IRS that you actually have a loss on your property
mhm.
because of depreciation. So if you look at your Schedule E, it'll be line 18. It'll say depreciation on there. If you look at Fannie and Freddie guidelines on how they calculate your income when you have rental properties and W-2, they're specifically supposed to add depreciation back to your income. And so it's almost like you never took it in the first place.
Hmm.
And so a lot of it is assuring investors that they're still going to be able to qualify for loans, even if they take the depreciation. Uh, and if your lender is telling you otherwise, you probably should work with a different lender. Yeah.
I mean, there's no reason to not take depreciation.
I there's high level, no, but nitty gritty, sometimes there is.
Hmm.
I would say if you're just, let's say you are somebody who, hey, this year you're full time, entrepreneur, and you're just getting your business started, maybe you might be in a lower tax bracket than you will be in a few years once your business is off the ground.
Hmm.
You may not want to take depreciation early because you're going to be in a super low tax bracket. So, for example, like, I had one guy come to me who he only made 30 or 40 grand at a W-2, but somehow he was able to buy 3 cabins in Pigeon Forge. I have no idea how, but he did cost segregation on all of them, and he was expecting this big, massive refund. And it was like, well, you didn't pay anything into the government, so you're not going to get any of your money back because you never paid taxes to begin with. So, in a scenario where you're not making a lot of income, or you think, hey, I'm making this much now, but maybe in the future I'm going to make double or triple. You may want to wait to do it in the following years rather than this year. Or
Hmm.
maybe you get married the next year, so then your tax bracket goes down. There's very nuanced cases in which you wouldn't want to do it, but generally speaking, if you're a high earner and you materially participate, you're going to want to look into this strategy.
Okay. Well, that's that's a really good point because obviously there's no point in bonus depreciating everything if you didn't really pay anything in to the government to begin with. And in terms
Yeah.
of like what things are clients, and obviously I know that you're not the cost segregation engineer, but if you wanted to just like color in the picture for some of the audience, who are managing a short-term rental, what things is that cost segregation engineer looking at in terms of line iteming?
Yeah, so that's actually a great question because I recently just started speaking out about this. I would say the last couple of months, as far as how do you maximize the benefit, like what particular property and what areas to look for
Hmm.
when you are buying short-term rentals. And I'll caveat it by saying we don't want to invest in real estate solely based on the tax benefits. But if you are somebody who's high W-2 income and you're hunting for some of those tax benefits, where you buy and what you buy is so important when it comes to tax strategy. So to break it down, a $700,000 property in the Smoky Mountains can yield the same tax benefit as $1 million property in Destin, right? So a $700,000 property in the Smokies can yield the same benefit as $1 million property in Destin, and it all has to do with the amount of the purchase price that's associated with the building and the land.
Hmm.
So the land component. So let's say I have $1 million purchase price
Hmm.
in the Smoky Mountains. 10% might be associated with the land, so I'm able to depreciate 900,000. However, in Destin, Florida, 30% or 40% of the building of the purchase price might be associated with the land. So in that case, I'm only able to depreciate 700,000 as opposed to a million. So even though I have a higher purchase price in Destin, I still could have the same tax benefit as the Smokies. And
Interesting.
what I teach my investors and what I teach a lot of people to do is when you're looking at your targeted property, you're going to want to go on the Zillow and Redfin and go there and see recent sales in the area of your similar square footage and bedroom and bathroom. And you're going to want to look at, hey, what was the breakout between building and land on those properties? So you'll be able to look at the 3 or 4 recent comps,
Hmm.
see how they're broken out between the building and land. And the 2 reasons you're going to want to do this is, number one, everybody knows that when a sale of a sale of real estate will trigger the tax reassessment. So if the previous owner was paying, $2,000 a year, and they've owned the property forever, well, the sale is going to trigger reassessment. So you're going to want to know how much the property tax bill is going to go up anyway, so you can
Hmm.
plug it into your pro formas. But also, now that you're doing that exercise, you're going to be able to know the breakout between building and land to know what you can expect from a tax perspective. Again, we're not buying solely based on the benefit, but if you're neck and neck between two different geographical areas, where you buy could be so important.
No, that's really solid advice, and that's probably a secondary thing, obviously, but also if you, like you said, if you're split between something, that's an interesting thought process in terms of making a decision on your purchase. What about in terms of how about the nitty gritties of how this happens? So material participate. There's
Uh,
some people want to
let,
say that there's a gray area in this.
Let me go.
But
Let's go back. Let's go back because I got more. I got more on the last
oh, you
topic. Go
got
back.
more. Okay, go
Yeah, I
ahead.
got. All right, I got more. So when you're looking at a property, generally speaking, the newer the property build, the more you're going
Mhm.
to benefit because the components of the building are newer. The
Mm.
structure is made out of newer things. So a 2000s property compared to a 1970s property, a 2000s property is generally going to yield more depreciation for you. Also, when you use a bird's eye view of the property and you see anything that's attached to the land but not the building,
Mhm.
that's going to be considered a land improvement.
Hmm.
So like a driveway, a patio, a fencing, um, anything that's not attached to the building is actually considered a land improvement, and it can be immediately written off in the first year. So when you're looking at a property and you see stuff, a lot of Joshua Tree properties have this where it's like the building, but then there's a bunch of stuff in the backyard.
Mhm.
Those are all land improvements and they're able to be written off the first year. So when I'm looking at properties, I want to see land improvements because I know that those can be written off. And the last part is townhomes and condos. A
Hmm.
lot of people don't like to buy townhomes and condos because they have, generally speaking, low appreciation compared to single family homes. However, townhomes and condos, you generally do not own the land that's associated with the building. And
Mhm.
so let's go back to the Destin example. I buy $1 million house in Destin, 30 or 40% of the purchase price might be allocated towards the land. I
Mhm.
buy $1 million condo in Destin, however, that $1 million purchase price all might be allocated towards the building because there's no land value.
Hmm.
And the way you'll be able to know this, again, is if you go on the county assessor website and look at the property tax card, or you could simply just call them and ask, hey, does this condo or townhome have land associated with it? 90% of the time the answer is no, but just double check. So your condos, townhomes, and then some HOAs don't even own the land either.
That's a huge swing,
Mm-hmm.
right? Because if it's the usual almost like 80-20 rule that it seems like on a long-term rental, a lot of people I feel like throw around 80% of building, 20% land, but if all of a sudden it's the condo and you're 100% building,
Mm-hmm.
that swing's gotta be significant in some cases, I would assume.
Yes, very. I mean, if the think of that difference between 800, 80-20 on $1 million property, you're talking about an extra $200,000 of building basis. That could be an extra 50, $60,000 written off.
God, interesting. So don't automatically write off condos and their super high, HOA is what you're saying, huh?
Yeah, yeah. No, I'm just making sure everybody's aware. That's all. I'm just trying to do my best.
Dude, no, that's good. I mean, that's, as I think, eventually, one of the end goals for me, make enough money to where could you buy a condo in Hawaii that's, has a crazy HOA, but if you can offset obviously some of those operational costs, and at this point I'm not doing it for cash flow just because I want a place in Hawaii. Could I do it just and have some extra tax benefits on the side?
Well, you bring up a good point. This is also something I've talked to a lot of people about. Is in a year like we are now, where it seems like the second half of 2022, a lot, bookings are down for the most part in some areas. Carrying costs are higher now because pretty much everything's more expensive. Electric,
Mhm.
gas, heat, utilities are more. Bookings are down. One of the ways you can actually see some sort of cash flow per benefit is to tap into the tax strategy and save money, because if you're able to add that, you get a $60,000 write off against your 24% tax bracket, you're able to save 12 or $13,000 in taxes. You plug that into your net operating income, and now you have a new cash on cash return theoretically, because
Hmm.
you're able to tap into the tax benefits. So in a year like now, it helps you because it's going to allow you to harness some of those benefits and basically save your ass from not having as much bookings as you thought. So
I feel like most calculators don't have, I mean, and I would understand why, but like they don't have a tax component, right? Of this could would be an added benefit. And
well, that's a great point. So you can navigate on over to learnlikeacpa.com, go to free tools, and click on STR calculator for my short-term rental calculator that has the tax benefits.
damn,
Thanks.
it
That was
can.
easy.
I promise that was not a softball, Tim. I was thinking about all the I have bankrolled so many templates, and if anyone who's watching this has too, like, let me know how many templates you've downloaded, even if you've downloaded some of mine, because none of them do. But apparently now I got to go find yours. I like it.
Thanks for that free softball there.
Okay, and this is because so I posted that cost seg thing on TikTok, and it got both on Instagram and on TikTok. It got a decent amount of like shares and saves. Um,
Mhm.
it's over 100, and there are people who you would either message me afterwards and say, "What the heck does material participating even mean?" So, like, what does that actually mean if they want to take advantage of the strategy?
Mhm. Yeah, so material participation is essentially you're doing activities that are essential to the business operations, to that particular property's operations. So, going to a conference or going out to eat or kind of doing something that's general, not necessarily specific to one particular property, it's not going to be material participation hours. However, if if I go to my property and I sit there while I'm getting bids for a contractor, that's something that's specific to that property. I'm going to be able to count those hours. Or if I'm doing Airbnb, a verbo optimization for that specific property, those are going to be material participation hours to that property.
What if you are like, let's just take my Joshua Tree property that's 8 hours drive away. Does drive time count?
So unfortunately, the travel time to and from your primary residence does not count. And the reason why is because it's very ripe for abuse. Let's say you're in California and you have a property in the Smokies and you need 15 hours. Everybody's just going to drive instead of fly.
It's true.
So your travel time to and from your primary residence to the property is not going to count.
So what happens if then, and it has to be active work that you're doing. So if we stayed in the property and obviously got some contractor bids and oversaw some work and redid some furnishing, there are actionable hours that we're logging. But in terms of obviously overnight sleeping, I'm sure those are also too much of a gray area where you don't log.
Right, exactly. I would not log any hours outside of normal working hours, 9 to 9 or so.
Okay, fair enough.
Yeah.
What's been, I don't know, now that you've seen a few, what's been the craziest on the short term? Not because obviously this has been a multifamily trick for decades that has just now, and largely, I mean, I'm going to say I heard it from you, and you're one of the people that I've heard it from first and probably talk about it the most. What's been like the craziest amount of write-offs that you've seen on one property?
We just got done doing a little over a $3.2 million property.
Okay.
That yielded about $800,000 in first year depreciation. Yeah.
Dude, $800,000?
I actually, interestingly enough, one of my clients is a starting professional athlete.
Okay.
And his wife, one of the big sporting events, NFL, NBA, MLB, I can't say which one, but wife is using the short-term rental loophole to help offset his professional league salary. And this was that example. Yeah.
Interesting. That is
pretty cool.
I mean, that's fun, man. Because obviously think about,
Yeah.
and if you're just tuning in now, the caveat is you offset it with a high active income, and this is the best way to do it. Then you're kind of just snowballing. You have to buy one every single year. But I mean, yes, a professional athlete would definitely fall into that bucket.
Yep.
So if anyone who's watching this has any questions, let me know in the comments. I got one here for you, Ryan. Let me pull it up. Where did it go, actually? Comments. Here it is. All right, Bobby. Do you conduct a cost segregation every year or once for the next 27 and a half years? I heard the tax benefit will reduce 100%, 80%, 60%, 40-20 by 2027.
It's a good question. So first, you want to figure out what type of real estate you're dealing with. If it's single family, multifamily, apartment buildings, most of the time it's going to be depreciated over 27 and a half years. If it's a short-term rental or commercial property, it's actually depreciated over 39 years. If you're doing, so you normally 90% of the time you would only do a cost segregation study one time, and it would be in the year that you place the property into service. So you would, in year one, 2022, you'd place the property into service. You would get 100% bonus depreciation on the 5 and 15-year life assets. The building value, either 27 and a half or 39 years, would be depreciated over the remainder of the life. Now, one thing that's interesting point to bring up that I actually recently just confirmed with some of my depreciation experts is that if you place a property into service in 2022 and decide not to do the study because maybe you already have enough write-offs or your income isn't high enough, if you choose to do the study in a following year, you actually, so let's say I buy a property this year, but I don't accelerate the depreciation because I don't think I'm going to qualify for material participation, or maybe I bought it towards the end of the year, so I'm not going to get my hours, etc. As long as you place the property in service this year, you're actually able to do a change of accounting method in 2023 and take 100% in 2023, not 80%. It's all based on when the property is placed into service originally. So, but if you bought a property in 2023, placed it in service in 2023, you would only get 80% of the benefit. Yeah.
Well, that's fun. I mean, so, and back to Bobby's question here that's on the screen. And if you're listening to this on the podcast, that's more excuse, I guess, for you to go back onto YouTube now so you can see what the questions are on the screen. But the tax benefit, is it changing from 100%, 80, 60, 40 per year, the bonus appreciation?
Yeah, so it's doing what's called sunsetting. So it slowly fades out over time until ultimately by 2027 it goes down to 20 or 0. The idea, I mean, at least me personally, what I'm thinking is that if our economy sort of looms recession, one of the things that the government can actually do to incentivize people to build and hire and do more stuff is to keep the gravy train rolling. So for them to not let it expire. So there's a good chance it could keep going, but we don't know. I mean, current administration and Congress, we don't know what they're really going to do in regards to this. But just thinking with my few economic class background and my common sense that they would want to encourage economic behavior, so they would keep the 100% or at least the 80% going for perpetuity. The other thing I wanted to note, and just to go back to the question, is you generally only do it one time. However, if you have massive renovations to a property after you've placed it into service, there could be a potential for even more tax savings if you do a Part 2 study. And so let me give you an example. So let's say, I bought a commercial building for $2 million. Let's say the roof on that property itself is worth $100K. The roof is worth $100K. I can do a cost segregation study in the first year, and then let's say I have to replace that roof in year 2. Well, if I do another study in year 2, a Part 2 study, I'm able to identify some of the stuff that I replaced. And therefore, I'm able to actually remove the old roof off my balance sheet and put the new roof on. Because otherwise, I'd be depreciating 2 roofs at the same time. And therefore, I'm able to actually remove the old roof off my balance sheet. I'm able to expense it. It's able to give me, and then I do not have to pay the depreciation recapture because it's off my books. So that's what's known as a partial asset disposition. When you're talking about the 500,000s and the $1 million properties, it could be very substantial to do a Part 2 study.
Okay, so let's touch on the recapture. No. I like it, and this is obviously because I'm going through my cost seg now for our Joshua Tree Airbnb, and so what does recapture mean? If we wanted to say sell this down the road, what would we expect?
So the depreciation recapture is actually made up of 3 components. I'll explain 2 of them just to keep it simple. So the first component is going to be on the portion that's allocated towards the building value itself. And so that recapture tax, so let's just say I had a $500,000 building and I depreciated down to $300,000. That $200,000 depreciation there, I'm going to get taxed at my tax rate up to 25%. So whatever my tax rate is, capped at 25%. So even if I'm in a 37% bracket, I still only pay 25% on that portion. Okay. However, the portion that's allocated towards the accelerated depreciation, there's no cap on that sort of recapture. So when I sell a property, if I sell it outright, I'm paying all the depreciation recapture back. Gotcha. There are strategies and ways to avoid it, such as buying more property, 1031 exchanges. I like an idea called the poor man's 1031 exchange, which is actually one of my podcasts. It's a lot to get into on this call, but
what's the high level? Give me the high level, because now you got me intrigued. What is the poor man's 1031?
So the high level is it's for if your 1031 exchange goes kaput and you're stuck kind of looking at a way to offset your capital gain. you're simply able to just buy the same new property that you would have bought, place it into service, accelerate the depreciation. But the benefit of doing this actually is, number one, you don't have to worry about any sort of time constraint. So you don't have to worry about the 45 days to identify, 180 days to close. And the best part about it is you get a stepped up in basis on your new acquisition rather than having to use the carryover basis in your old property. It's just very technical terms here, but it could result in tens of thousands of dollars of savings.
Interesting. All right. So the net of this conversation is, obviously, if you have a CPA and or you don't already, you need to talk to yours and or Ryan as soon as possible. That way you can figure out, I mean, regardless, I feel like if you're making a decent sized move where you're buying, selling, doing a cost segregation, you should have someone who actually does this all the time to just back you up. It makes no sense. And you could be leaving thousands on the table.
Yeah, I mean, I probably see it like once every month. Somebody posts in one of these Facebook groups that they sold a property and they're looking to 1031 exchange. It's like, you missed that part where you actually have to have the qualified intermediary receive the funds at the closing. Or, you know, just some stupid stuff where, you know, the ignorance, or I guess you want to say just thinking that they can do it themselves, kind of costs a lot of people. Because for most people, tax is like an afterthought. They're like, oh, let me deal with that on the back end. But for, you know, planning ahead and tax can save you tens of thousands, if not hundreds of thousands of dollars a year, depending on your situation.
Well, I mean,
honestly.
also true. I mean, like, as you're thinking about the original example that you gave us, it could be, if tax is a stronger priority for you, it could be cheaper to buy a cheaper property in one market versus a more expensive property in another market, tax wise, than a cheaper one in a first market, right? So, Bobby's on a roll today. Can you combine more than one cost seg for your multi-family duplexes when you do your taxes? Do you know what that one means, or?
Yeah, I guess so. If you had more than one property, you could do the study on both of them if you wanted to. The only caveat there is how do I explain this? So there's a decreasing marginal return the more you do it. And this is how I explain it. So let's say I'm in a 32% tax bracket. Well, let's say I take $50,000 or $60,000 of depreciation. Let's say I have $100,000 of depreciation total. Right.
Okay.
I take 50 grand of depreciation at a 32% tax bracket, and then I fall down to a 24% bracket. It goes from 32 to 24. So I get my 50 grand at 32, but then I'm down to 24, and I get 50 grand times 24. So basically, the more you do it, the decreasing of the benefit it becomes, because ultimately you'll fall all the way down to zero. And that might be your cup of tea, just like, hey, zero me out, let's do it. That's fine, perfectly fine. But just know the more you do it, you know, especially if you're making millions anyway, you're going to be 37% tax bracket all the way, and it doesn't matter. But if you're, you know, a normal person, 100, 150,000, $200,000 W-2, you're going to have this decreasing sort of marginal return the more you do it, because you're going to keep going down in your tax bracket. So
interesting. I like that.
That's where I'll look at a taxpayer situation and say, hey, you know, what was his name? Hey, Bobby, you can do both of them, but it's like, should you? And that's actually a huge conversation, I think, in tax. Any sort of tax and financial planning is, yeah, here's this rule. It's out there for you. Here it is right here in the code. But should you do it? You know, depending on your situation, right? Yes, everybody can do it, but should you? So, for example, like I posted a video on my Facebook group. I did a webinar on self-directing your IRA to buy real estate. And her name was Veronica. She commented and said, "Hey, you know, my financial advisor is telling me that I can take out $10,000 out of my Roth IRA to go buy a home." And I'm like, "Oh yeah, you can definitely do that. That's right there that's right there. But should you do that? That is where it's like, I would much rather have that money inside of your Roth earn and grow tax-free for the rest of your life, rather than take that out to buy a primary residence. I'd much rather you honestly take out a personal loan or run a line of credit than tap into your Roth IRA. So again, another one example of you can do it, but should you? Yeah.
In what random instances are you telling people to? Because I mean, I asked you before, like, what things are the hot topics right now, and how could someone, in what situation could they utilize their Roth to then buy investment properties?
So what we're seeing now is because people are taking the depreciation against their income, they're lowering their tax bracket. And so, if I'm in a 32% tax bracket, but then I have all this depreciation and I'm actually now in a 12% tax bracket, well, one of the things that I want to look to do is maybe convert some of my retirement accounts over to Roth or contribute to Roth retirement because before I was paying 32% on the dollar to convert. Now I'm only paying 12% on the dollar to convert. It makes it very strategic for me to want to move some of my retirement assets over to Roth. Um, on the flip side, same goes for if I'm actually trying to withdraw money out of my retirement account. Now, I wouldn't recommend it because there's a penalty associated with it.
Hmm.
But same sort of scenario. If I'm in a 32% tax bracket and I go to take money out of my retirement, I'm paying 32% or more. But if I'm able to offset my income, so not only in a 12% tax bracket, I only have to pay 12% on the retirement money that I take out. A lot different than paying 32%.
So you're using the tax penalty to lower your income, basically. Is that what you're saying?
No, I'm using the cost segregation to lower your tax bracket,
To
which in
then take
turn
out money.
is, yes, yes.
So you're just stacking them now.
You're stacking strategies. Yeah. Yeah.
Dude.
And so another one that's cool is if you type in the long-term capital gains tax bracket, which is
Okay.
basically your gains that are on sales of assets such as stocks and rentals, whatever. If you're able to accelerate your depreciation to lower your income, you're able to cash out some of your stocks and some of your rental portfolio at lower tax rates. So that's another thing that we've been looking to help clients with this year is if they're looking to get out of the stock market or look to
Hmm.
move some of their assets more into real estate, we go through this analysis with them of what they can do. I'm a big proponent of building wealth any way
Hmm.
possible, not just within real estate, but you have some clients that they get a taste of short-term rentals or real estate and they're like, I want to go all in. What are my options to sort of look to some of my retirement accounts or uh, my stock portfolio?
Dude, that is yeah, that is interesting, right? Because as you think about, should you switch to full-time real estate investing? How does that affect any tax strategies that are there? Now you're talking about not only just the baseline of, hey, do the cost seg because it's amazing for your W-2, but could you stack something? Could you move money then to also offset? Like that is thinking chess moves like crazy, man. Good job.
Yeah. It's almost like so I'm not a big soccer fan, but what I'm told is like Lionel Messi,
Okay.
he's always playing 3 or 4 passes ahead. So if the ball's over here, he's thinking about, okay, where's the ball going to be in 2 to 3 passes?
Mhm.
That's almost like where I'm at as a tax advisor, sort of wealth builder is,
Mhm.
hey, I don't want to just save you money this year, but what are some of the decisions and the moves that we can do that's going to save you taxes for the rest of your life? Right. So it's not just about, I guess it's not just about saving money now, but it's more so how can we save you money for the long haul?
I mean, I think just like short-term rentals, everyone thinks the cash flow is amazing, which it can be, depending on
Hmm.
the market, all that good stuff, right? And it's the fun, sexy thing. And so is the cost seg. When you have a buddy who texts me and says, "Hey, I could get 130 grand in a write-off off one property." Like that's just mind-blowing to me,
Hmm.
right? And that's the sexy thing about. But then when you also add in other moves that you can make to not only get that, but also enhance it, like that's just, dude, that's next level.
Yeah. And it's life changing, man. I mean, it really, one particular client this year, we were just trying to map out her escape plan from the Matrix.
Mhm.
And so just to give you some background, she's like a VP of a marketing company, 32, 33 years old. And she's like, hey, I want to plan on retiring by the time I'm 45. I want to have enough real estate, enough cash flow, enough whatever. And I sat down with her and like modeled out her plan in an Excel. And it's like, hey, you could probably actually retire when you're 38 instead of 45.
Hmm.
And you wouldn't believe it, but she actually cried on the video once I dove into the numbers and showed her like, hey, this is, if you just made this much money per year, you invested it, savings here, reinvested these profits in a perfect world, right?
Yeah.
If that happens,
Which
but
made a plan.
yeah.
And I think ultimately everyone knows they should be buying more real estate. Everyone knows they should invest more in the stock market, save more budget, yada, 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 personal finance whiz. But I think if you can just sit down and itemize it, right, and you reverse engineer it to reinvest this amount, buy this at least a minimum amount of this properties. Here are the tax implications, and you factor it all in, and then I'm sure you just delivered it in a nice little PDF, and you said, "Here you go. Welcome to 7 years early." Right?
Yeah, yeah,
That's a different
right.
story, man.
Yeah.
Dude, that's awesome.
Well,
All right, before I know it's late where you're at.
no, we're good.
Last
I
couple
got time.
questions because and if anyone else is on here and has some more questions, look at that. Bobby helping me out. Be sure to like this too. If you're watching this right now, just give it a like. Just hit the thumbs up just for us. Thanks. um, okay. As you're going to these conferences and you've been posting a lot more, like I want to dive into marketing. Like, what have you gotten as a result of posting more? Period.
I think it's really about becoming that person of interest
Okay.
that, hey, whenever somebody thinks about real estate and they think, oh, I made a ton of money this year, I need to figure out how to save money on taxes. I or a few other people are the people that they think about. And that's from becoming the person of interest in the work that I do, teaching
Mm-hmm.
people how to save money on taxes, teaching people how to build generational wealth, etc. Uh, you become you become that person of interest through your content, through your advertising, your marketing, etc. But more so from the engagement that you have with your audience. I mean, I really do try to respond to every single comment. Also, um, me personally, I try to respond to every single DM. I may not get back to you quick, but I normally respond to my DMs during when I'm working out during workout sets. But really sort of build that personal brand and that credibility.
Mm-hmm.
And and I think what also helps too is I'm not just speaking it, but I'm actually doing it myself, right? Like I'm actually investing in rental properties, and we haven't even talked about the deal that I'm doing now, and some of the other deals that I've done. And so to not only kind of talk about it, do it, but also on the other side, clients want to see that I'm actually doing what I'm, practicing what I'm preaching.
Yeah.
And actually, if you go on my story, I actually posted that I finalized my personal tax return, and it had a zero balance owed because I was able to do some tax planning to make sure that I didn't owe money or get money back. So
So
some of
you
my
did zero yourself out then?
no, so I had to I had to make a comment to clarify. I did not zero myself out. I made sure I had enough paid in before the end of the year was over to make sure I didn't owe money or get back money.
Mm.
So I didn't zero myself out, but
Dude,
I did tax planning enough to make sure I hit it right on the head. So
interesting. Yeah, I've always like, how hard is that to do?
very. Like you have to have, you have I mean, last year for me it wasn't bad because I only had maybe 3 or 4 streams of income between, my W-2, my business, a
Mhm,
couple rental properties. 2022 it's going to be a lot harder for me because I have 8 or 9 or 10 streams of income
mhm.
between multiple rentals, multiple businesses, other ventures and stuff. So it'll be a little bit harder the more complex your situation is. But normally, I try to fine tune it within a few $1,000s for most people. Get it,
Yeah.
get it, get it pretty close.
I mean,
So
I saw that post and I just thought, like, immediately in terms of the tracking that's needed, like,
it helps that I'm a CPA. So
it's true. Okay. So we're talking about tracking, and actually, my business partner Ash gave me this one to ask you. Or in general, not just like long-term rentals, but just in general, like what are some random things that people, now that they have an investment property of whatever shape and form, like what things should they be tracking throughout the year?
yeah, so you're gonna want to make sure that you're getting all your expenses sort of documented and listed. There's a lot of things that kind of go under the radar if people don't have proper bookkeeping in place that they sort of miss out on. So some of the key ones that I always see, you're operating Airbnb from your phone or your laptop, but you're not writing off maybe your cell phone bill or part of your home office. Um, some people go to their Airbnb to visit it. Are you writing off those travel costs that are now associated with you having to go back and forth to your Airbnb? So some of the things that a lot of people who don't think bookkeeping is important,
Hmm.
they're going to miss a lot. And I think, especially if you're not doing your books on a monthly basis, if you try to come back at the end of the year, you're going to miss so much stuff. And I know you do a good job of keeping your books in tip top shape. So I don't have to, I don't have to scold you for it.
No, we are trying to get better, but man, it is. We also, between a million different partnerships and things like that, and just scaling has its problems.
Hmm.
So, um, right on, man. Well, dude, this has been. I'm excited to see what actually happens with our cost segregation. If you had any just parting words for the audience here, you got 2.5 months left of the year. What should people be doing tax wise?
Yeah, I would say get everything in order now so you can make your life a little bit easier as we approach the tax filing. Maybe get on the phone with an advisor over the next month or so to see if you have to make any moves before the end of the year because your tax return is based on all the things that you did in the prior year. And
Hmm.
so you can't wait until after December 31st to start thinking about taxes because the year's already over. After December 31st, there's only a few things that you can actually do to make your tax liability go up or down. Um, and I would go further to say that it's the rich, poor, lower middle income class families. They find out how much they owe or get back on April 15th. On April 15th, so they
Okay.
find out after, right? Whereas like it's your rich and your wealthy, higher middle income class people that they know how much they're going to get back or owe on April 15th before April 15th. They already know months in advance, what are they going to get a refund? Are they going to have to owe a little bit of money? And so there's no surprises there. And what happens is, I've talked to a few people last year or this year where hey, we made a ton of money. And then come tax time, we had to cut a $25,000 or $30,000 check. Well, we were trying to close on a house at the same time. And you can imagine how that would go with a
Hmm.
lender when they see a $30,000 withdrawal out of your account. It could crush you if you're not tax planning and doing that appropriately. Because just having a CPA file your tax return is not tax planning. You actually need to be working with them, quarterly at least. I would say twice a year, maybe, to project your sort of bracket in
No,
your
I mean
plan.
that's totally true. And as you think about obviously towards the end of the year, I guess that's why a lot of the ultra rich will buy private jets and some crazy cars in December, huh?
Yeah, actually, the busiest day of the car dealership is normally the last day of the year or the last week, even though it's at least in the Midwest, it's freezing. But no, I mean, a lot of people are buying assets and because it's all about when you put it into service, right?
Hmm.
And as long as you have it in service, yeah, you're good to go.
How about right here? Last question. How often should you meet with your tax accountant during the year if you're a small business?
I think that depends on how small. If you got, I would say let's just throw a dollar on it. Let's say sub 250K of income. You probably meet two or three times a year. You got a half $1 million business, multiple employees, different states, etc. You probably should be meeting at least quarterly, if not maybe every 2 to 3 months.
Yeah.
It really just depends on your situation, but meeting with them, I would say meet with them at least, twice and kind of get a gauge of what you're going over. Because if you find out that you're running out of like things to discuss, you probably only need to meet those two or three times. Whereas, I meet with people and it's like, hey, after three or four phone calls, we're still not done yet with planning. So it really just depends on your situation. A lot of it too depends on what do you want to put in as a person. So, for example, all the stuff we're talking about here today, it's covered in all my podcasts. Like
Hmm.
I don't hold anything back. I mean, there might be a little niche, nuanced strategies that I don't open up to the public, but 90% of what I do is actually already covered in my podcast. And so everything's out there for you to learn when it comes to tax strategy. It's just, do you want to take the time and effort to actually learn it? Some people would rather just pay my consulting fee for me to teach it to them, and that's completely fine. That's why I'm here. So.
True. I mean, the tax code is public, right? So if you want to go at it,
yeah, go ahead and read through the 70,000 pages if you want. Feel free.
No, I mean, that's all good fun. I mean, it's interesting. I mean, you think about that with anything, right?
Mm-hmm.
If you want to buy an investment property,
A
start an
mentor.
Airbnb.
Yeah, a mentor too, right? Like you could, you're buying your first property or you're doing your first RV deal or multifamily. You can make the mistakes on your own. It's going to cost you so much time and probably thousands, if not tens of thousands of dollars for you to make those mistakes.
Mm-hmm.
Or you could invest in trying to find a mentor who's already been down that path that can say, hey, don't buy this property. It's a bad deal. Don't, make sure you look for X, Y, and Z. It's going to make your life a lot easier. So instead of making those mistakes on your own, why not, at least try to get a free mentor or pay a mentor to help teach you the things you have to look out for.
Totally.
Joshua B. mentorship program coming soon.
I mean, I would say to add on that, is yes, you can have a mentor, 100%. Like that works. But if you are cash strapped, right, you can also just find the person who's one step ahead. A lot of people will discount that. Like they want to go to the guy who has 100 doors and that's who they only want to go to. But if you go to the person who's one step ahead, they're also more likely to help the next guy coming up.
That's true. Yeah, right.
And sometimes if that's what you just need to jump in, then that's what you need to jump in. Dude, what are you working on right now? Anything you want to share?
So we are doing, let's see. So we are doing a glamping resort in Branson, Missouri. We are doing glamping tents, single family homes, RV pads, and we are opening it up to debt investors right now. There's tons of traction in that area when it comes to, there's a lot of money that's being put into this area for various projects and NASCAR and water parks and lakes. And it's going to be a huge project. Actually, the first project that I'm a general partner on. I'm looking to take some of the experience that I learned from this to eventually do my own syndications.
Yeah.
That time will come.
For sure.
I'm super excited. We actually have I'll just plug it real quick. We're doing a webinar. I'm actually going to be breaking down the tax benefits of investing in an RV park.
What is that?
That is going to be, let me double check here so I don't give anybody the wrong date. You could actually find that on Zasha Smith's Instagram. So if you go to invest with Zasha, she'll have a link there for you. I got to add the link to my page actually.
Here, I'll put it on the screen right now.
Yeah.
And I will say, we're also in the same market. So Ash and I manage a short-term rental that's in Branson, Missouri. We were also under contract for an RV park that is 20 minutes away from Ryan's RV. And he actually didn't even know about that.
No, dude. That's what I'm saying. Like, why does it take forever for us to connect again?
I mean, your guys' team is doing, I'm really excited for the plans that you guys have. Their property is much bigger than ours. And they have, I mean, if you want us to break down a whole RV thing and a future thing, we can get all the team members involved, throw out ideas and plans and just have at it. Let us know. We can do some kind of follow-up episode. If you are interested in investing in an RV park or just have random questions, leave them in the comments too. So if you ever do any kind of follow-up, that just helps us.
Mm-hmm. So it'll be October 27th at 5 p.m. Central Standard Time.
Sweet. And that is right here. So if you go to Zasha's page, Ryan will eventually add it to his. If you're not already following Ryan, I don't know what you're missing out on because every single day you just get a new tax tip. You wake up, boom, another tax tip from Ryan.
Every other day, it's right there in your face.
I like it, man. Well, I appreciate you coming on. Where can people find you?
Yeah, so I'm on everywhere at Learn Like a CPA. So Instagram, TikTok, Twitter. Got a Facebook group that's going to be tax strategies for real estate investors. I'm on tour. So going, I just got back from Vegas. That was awesome. Shout out to Patrick and Stephanie for putting together STR Nation conference. I'm going to Charleston this weekend, Nashville next weekend, Nashville next month, Destin in Florida. So if you're interested in one of those spots, shoot me a message and I can see if we get connected.
Dude, that's the most outrageous thing. I'm going on tour.
Yeah, I guess that's what it is.
But I like it, man. I'm so stoked to see wherever you go. Next year, I do want to travel more so I can follow along and fanboy behind you. You know,
Yeah, and hopefully we have a meetup, man. I need your conference. We
dude,
need
just
something
come
out
out.
there.
I mean, anyone who's watching this, I guess he plugged an event. I will plug an event now. If you guys are in the Bay Area, we are gonna host a real estate holiday meetup here in San Jose, December 3rd. So if you ever want to come out, Ryan, you can come out. But that's then December 3rd. Be a dinner and a mixer. We have 2 speakers confirmed already. We have our flipper friend Marjorie. So if you want to learn how to flip in the Bay Area, which you all know it's really, really expensive, but that means it could be decent margins if you find a good deal. And also the one and only Jesse Vasquez for midterm rentals. Have you gotten into midterm rentals yet, Ryan?
Yeah, I'm actually going to convert one of my short-term rentals in a seasonality market to a midterm in the off months. So flipping it to a midterm probably November to February or March, and then coming back on with a short-term rental.
I like it.
So kind of, but it's
Hybrid.
primary. It's not primarily supposed to be a midterm rental, but it's a short-term rental that's also going to serve as a midterm rental.
Dude, that's all. Okay, last one for you. Predictions for 2023. What is everyone going to be talking about in real estate?
The opportunity that's going to happen.
Oh,
Yeah, so much opportunity. Once these interest rates come down, prices come down a little bit, it's just going to explode again because people are going to have the cash. But I would also say too, what I'm seeing is there's a lot of opportunity. I mean, I put in 2 or 3 offers, and there's been no other offers on the table. And so, yeah, interest rates are up a little bit, but that also means there's less competition. There's less eyes that are on deals. So
mm-hmm.
I'm not going to get outbid by somebody from California with all cash anymore. I'm going to actually have a fight in the game, a dog in the fight. So there's a lot of opportunity right now, even with the higher interest rates, if you can price that into your deal. If you can price it into your deal, like I said, there's just the days of a million offers are gone. It's a huge opportunity right now. We're not at the point yet where seller financing is going to be extremely popular, but if the Fed does keep raising rates, especially 8.5, maybe up to 9, we might see a lot more seller finance deals, subject to deals also as well. So be on the lookout. There's going to be a lot of opportunity, a lot of opportunity.
I like to hear that you're not backing down. I mean,
No.
we're not backing down either. Honestly, I like the environment right now because, like you said, there are less just people looking, which means the competition is less. And as long as you know how to run your numbers and you double check them, triple check them, and find someone else to also double check them, and you're buying on cash flow, I mean, I don't see why not.
Yeah. So Warren Buffett, the big guy of investing, he says you want to be greedy when others are fearful and fearful when others are greedy. And if you're dollar cost averaging your real estate over your life, what does it matter if you bought in at maybe a higher price point?
Mm-hmm.
As long as you're going to keep buying and buying, you're going to have enough over time. And so I think the person that loses in investing is the person that says, oh, I'm going to sit on the sidelines and wait to get back in when it's lower or when everything's fine. How are you going to know when it's fine? To go back to the stock market, have you been on the sidelines right now? I mean, the stocks are so cheap. They've done studies where, over the last 20 years, if you weren't in on the stock market for these 13 particular days or something like that, you missed out on half the gains.
Mm-hmm. Yeah. I mean, and most people are not that diligent in watching. So if you just consistently dollar cost average in to take stock terms into real estate and you're holding it for the long-term play anyways, I mean, why not?
Yeah.
Dude, man. Well, yes, if you're ever out in California, in the Bay Area, let me know. If not, maybe I'll just go out to wherever you're touring. We'll find out
Yeah.
where.
All right.
Hey, well, if you enjoyed this, please make sure you give this video a like. Please share it with someone. If you are thinking about starting a short-term rental, if you already have one and this is your first year, or I guess, I mean, according to the podcast, wherever you want, if you haven't done the concept yet and you want to learn more, you can reach out to Ryan. His social media is all linked down below, and then share this with them. One, that helps me a lot, and so thank you. But also so that someone else can also learn how they can get the best. I mean, this bonus depreciation off the W-2 is like crazy. And
Major.
obviously, if the percentages are changing every single year after this, there might be less of the pie, or the future could change otherwise. But for now, with the information we have, I mean, it's a pretty good dang time to take advantage of it. So,
Yep.
any last closing thoughts, Ryan?
Don't wait to invest. Invest and wait.
I like it. Hey, man, well, I appreciate it. Go follow him, and I will see everybody else on the next one. Good night,
Yeah.
everyone.